Section 6. External influences on business activity. Unit 1. Government economic objectives. Low inflation, economic growth, low unemployment, balance of payment, economic cycle, growth, boom, recession, slump, real income and disposable income, currency appreciation and currency depreciation, government policies, fiscal policy, monetary policy, supply side policy, direct taxes and indirect taxes, import tariff and import quota. Government economic objectives. Government economic objectives are the desired outcomes that the ruling political party wants to achieve for its country and economy. For government economic objectives: low inflation, low unemployment, balance of payment, economic growth. Inflation. Inflation is an increase in the general price level of goods and services in an economy. Consequences of inflation in a country. Inflation causes a fall in the value of wages to employees, and so they are unable to afford as many goods and services as before. The people's real income has fallen. Inflation causes reduced living standards to the society because businesses are unable to expand, resulting in fewer jobs and low variety of goods and services to consumers. Inflation causes reduced international competitiveness because prices of home goods become higher than prices of foreign goods. Inflation causes higher imports of foreign products. As a result, local businesses start to lose sales of home goods and the local businesses are closed down, causing high unemployment. Unemployment. Unemployment occurs when people who are willing to work and able to work but cannot find a job. Four consequences of unemployment in a country. Unemployment leads to loss of output because unemployed people do not produce any goods and services. Unemployment leads to increased costs to the government because the government will have to spend money on unemployment benefits and grants to unemployed people. Unemployment leads to a loss of income to unemployed people, and so they have a fall in their living standards, a decline in their spending power, and a rise of their debt problems. Unemployment leads to social deprivation such as crime, increased divorce rates, worsening mental health, and lower life expectancy. Economic growth. Economic growth means that a country's gross domestic product is increasing year by year. Economic growth has several advantages such as high standard of living, high real income to consumers, lower unemployment, low poverty. Gross domestic product. Gross domestic product is the total value of goods and services produced by a country in 1 year. Consequences of no economic growth in a country. Absence of economic growth means there is a fall in the total value of goods and services produced by businesses, and so lesser workers are needed, causing unemployment to rise. Absence of economic growth leads to poor living standards because people have lesser income to spend on goods and services because they are unemployed. Absence of economic growth means that businesses are not expanding because consumers in that country do not have enough money to buy the goods produced by businesses. Absence of economic growth leads to a fall in government revenue made from corporation taxes because businesses are making lesser profits. Economic cycle. The business cycle is also known as the economic cycle or trade cycle, describes the fluctuations in the economic activity and fluctuations in the gross domestic product of a country. The business cycle is classified into four main stages, namely economic growth, economic boom, economic recession, and economic slump. One, economic growth is a situation in the country where the GDP is rising, unemployment is falling, standard of living is rising, real income is rising, businesses are expanding, producing a variety of goods and services, and the country is making a balance of payment surplus. 2. Economic boom is a situation in the country where its economy has reached its peak development. Its economic indicators such as employment, industrial production, retail sales, GDP, consumers' purchasing power are at the highest. Also, it is a situation of high inflation. 3. Economic recession is a situation in the country where there is a decline in its economic activity. GDP is falling, unemployment is rising, real income is falling, businesses are closing down, and consumer spending is falling. 4. Economic slump is a situation in the country where there is a sharp decline in its economic activity. There is high unemployment, poor standard of living, no consumer spending, high poverty, high social problems in the country. Real income. Real income is also known as real wage. It is the amount of money an individual finally gets after adjusting for inflation. It means that when inflation is rising, real income and purchasing power fall by the same amount of the inflation rise. Balance of payment. Balance of payment is the difference between a country's imports and exports. A balance of payment surplus means that a country's exports is greater than its imports. A balance of payment deficit means that a country's imports is greater than its exports. Balance of payment deficit. A balance of payment deficit will not attract foreign direct investment into the country. It means that investors will not set up business in the country. This leads to no job creation and no foreign currency coming into the country. A balance of payment deficit will lead to an exchange rate depreciation or currency depreciation. This means that the value of home currency will fall against the value of foreign currencies. As a result, imports will become more expensive. Exchange rate. Exchange rate is the value of one currency compared to another foreign currency. What determines the value of exchange rates? Value of exchange rates or value of a currency is determined by the demand and supply of that currency. For example, if there is a high demand for USD, the value for the currency will rise and so that currency will appreciate. When there is a high supply of a currency, the value of the currency will fall and so that currency will depreciate. Demand and supply of currencies is caused by imports and exports of a country. When a country is importing more than it is exports, there will be more supply of local currency on the world market and so, its currency will depreciate. Currency depreciation means that more of a currency will be needed to buy other foreign currencies. When a country is exporting more than its imports, there will be more demand for its currency on the world market, and so, its currency will appreciate. Currency appreciation means that less of a currency will be needed to buy other foreign currencies. Currency depreciation. Exchange rate depreciation is a fall in the value of one currency in relation to another currency. For example, if £1 was worth $3, with a currency depreciation, £1 is now worth $2. This explains, if a person has one Great Britain pound, he could change it and get $3 United States dollars. With a currency depreciation, the person will change the one Great Britain pound and get only $2 United States dollar. Therefore, the person is getting lesser money from the £1. Currency appreciation. Exchange rate appreciation is an increase in the value of one currency in relation to another currency. For example, if one Mauritian rupee was worth 2 Indian rupees, with a currency appreciation, 1 Mauritian rupee is now worth 3 Indian rupees. This explains that if an individual has 1 Mauritian rupee, he could change it and get 2 Indian rupees. With a currency appreciation, the individual will change the 1 Mauritian rupee and get 3 Indian rupee. This means the individual is getting more money from the 1 Mauritian rupee. Government policies. Government economic policies are the course of actions and decisions undertaken by the ruling political party to address problems in its economy. Fiscal policy refers to the actions taken by the government to use public sector spending and taxes in order to influence economic conditions. Government raises money from direct taxes and indirect taxes to fund public goods such as public schools, hospitals, road infrastructure, and so on. For example, the government can decide to increase taxes in order to raise revenue to fund a public project. Monetary policy refers to the actions undertaken by the government or central bank to control interest rates and money supply in a country. In a condition of high inflation or increased consumer spending, the government can decide to increase interest rates so as to encourage savings and discourage borrowings. Supply-side policy refers to the actions undertaken by the government to increase the supply of goods and economic growth of the country. The government will focus on cutting taxes, lowering borrowing rates, and deregulating industries to encourage production of goods and services. Taxes, direct and indirect. Direct taxes are paid directly to the government from a person's or business's income. Examples of direct taxes are: income tax is deducted directly from the salary of employees and paid to the government. Corporate tax is paid directly by profit-making businesses to the government. Wealth tax is paid directly to the government from the wealth bank balance owned by a person or business. Property tax is paid to the government from the property assets owned by a person or business. Indirect taxes are paid to an intermediator when buying goods and services, and the intermediator then pays the tax to the government. Examples of indirect tax are: value-added tax is tax paid by consumers when purchasing a good or service. Sales tax is tax paid by producers and retailers when selling goods or services. Excise duty is tax paid by consumers when purchasing certain regulated goods such as fuel, tobacco, and alcohol. Custom duty is tax paid to the government when importing and exporting goods or services. Disposable income. Disposable income is the amount of money left to an individual for spending on goods and services after income tax has been deducted. Impact of income tax on businesses. Income tax imply a fall in disposable income available for spending by consumers. This will result in a fall in sales of goods and services produced by businesses. The business will decide to produce lesser goods, and so workers will lose their jobs because fewer workers will be required. Impact of corporation tax on businesses. Corporation tax will lead to a fall in profits retained by businesses, and so less money is available for expansion. Consumers will have fewer variety of goods and services. Corporation tax will discourage investors to invest in businesses because they will receive lower dividends. Share prices of businesses will fall. Impact of VAT on businesses. VAT makes goods and services more expensive to consumers. Demand for business products will fall, mainly luxury products. Employees' real income will fall, and so they will demand more wages. Business will make fewer profits. Import tariff and import quota. Import tariff is the tax imposed by government on imported goods, whereas import quota is a physical limit imposed by the government on the quantity of a product that can be imported. Consequences of an import tariff on businesses. Import tariff will encourage consumers to buy more home-produced goods than imported goods. And so, local businesses will benefit from high sales and profits. Import tariff will increase cost of raw materials to local businesses if those materials are imported. This will lead to high selling prices of finished goods to consumers. Import tariff can cause retaliation by other countries. That is, if country A is imposing import tariff, then other countries may do the same with country A. Country A will pay higher to export to other countries. Government spending. Government spending refers to the expenses incurred by the state in order to provide public goods such as free education, healthcare, transport, infrastructure, defense, social protection. Consequences of high interest rates in a country. Consumers will be encouraged to save money into banks instead of spending on goods and services. Demand for goods and services will fall, and business will face a loss in their sales. High interest rates will encourage foreigners to open a bank account in the country in order to earn high interest rates. This will increase the demand for the country's currency, and so leading to a currency appreciation. Local businesses will be discouraged to expand their production and operation due to a fall in demand from consumers. This may cause unemployment to rise because fewer goods will be produced. Supply-side policies. Privatization is the process of selling public sector organizations to the private sector. Private sector is more efficient and productive than the public sector, and an increased supply of goods and services, as well encourage new competitors. Improve training and education is when government spend on schools, colleges and training centers so that people in the economy can become better skilled and knowledgeable, helping increasing productivity. Increased competition is when government take action to reduce monopolies so as to increase the supply of certain goods and services. How businesses react to changes in government policies. Government policy, business decision, problem with the decision. Fiscal policy, to increase income tax. Businesses lower the prices of existing products to increase demand since consumers' real income has fallen. Businesses produce cheaper products so that they can charge lower prices. Business receive less profit from sales. The image and quality of the product may fall when using cheaper materials. Monetary policy to increase import tariffs. Businesses will buy local materials instead of imported materials to produce final goods. Businesses will produce and sell to local consumers because consumers will find imported goods more expensive than home-produced goods. The quality of goods produced can be reduced if local materials are of low quality. The business can make high profits and high sales because consumers will choose locally produced goods. Monetary policy to increase interest rates. Businesses will delay their expansion projects. Businesses will sell their existing assets and repay their loans. Powerful competitors will capture the market. The assets may be needed to run the business.
Thank you for watching.